Honeywell's net income more than doubled in the first 6 months of its fiscal year, up 115%, with diluted earnings per share of $20.39 against $9.34. On the face of it, one of its strongest half years. But operating cash flow over the same period fell 67% to $626 million, and free cash flow came in at $88 million. Two numbers, same filing, opposite directions. Let's work out which one describes the business and what the June spin-off of Aerospace changed. Honeywell International is a diversified industrial group listed on the NASDAQ, running on four segments this period: aerospace, building automation, process automation and technology, and industrial automation. Everything here comes from the 10Q for the first 6 months of the fiscal year, ended the 30th of June, filed on the 23rd of July. All profit and loss and cash flow figures are cumulative 6-month numbers, against the same 6 months a year earlier, not a standalone quarter. Balance sheet figures compare against the previous fiscal year end. So since the start of the fiscal year means a 6-month movement, not a year-over-year one. Revenue was $18.9 billion, up 3.4%. Gross profit rose only 0.9% to $7.2 billion because cost of revenue grew faster than sales. Operating income advanced 6.6% to $4.4 billion, twice the pace of the top line. Then the bottom line detaches. Net income of $6.5 billion, up 115%, with diluted earnings per share of $20.39 against $9.34, on a smaller diluted share count of 319 million. Three growth rates in one income statement, and the gap between them is the story of this filing. Here's where the doubling comes from. Operating income was $4.4 billion. Pre-tax income was $8.15 billion. That's roughly $3.7 billion of profit below the operating line, not earned by selling more products at better margins. Tax rose to $1.67 billion from $613 million, and net income landed at $6.5 billion. Net margin is 34.5% against 16.5% last year, an 18-point jump, while operating margin moved less than a point. When net margin sits 11 points above operating margin, the profit isn't coming from operations. So what happened below that line? On the 29th of June, Honeywell completed the spin-off of its Aerospace Technologies business into a separate, independent listed company, shareholders receiving one aerospace share for each Honeywell share held. Separation, tax matters, and trademark license agreements govern it. Now look at that date. The 29th of June is one day before the period closed, creating a mismatch running through the entire filing. The income statement and cash flow statement still consolidate aerospace for essentially the full 6 months. The closing balance sheet no longer does. The large below-the-line result is consistent with that separation. And aerospace was 46.9% of 6-month revenue, so almost half the revenue base you're about to see is leaving. Aerospace was the largest segment, $8.85 billion of revenue, 46.9% of the total, growing 4.4%. The business now separated out. Building automation was the standout on growth. $3.88 billion, up 10.4%, just over 20% of group revenue. That's triple the group's 3.4%. And it's the segment whose importance changes most after the separation. In the remaining company, it moves from roughly a fifth of revenue to a much larger share of a much smaller base, one of the more consequential shifts in this filing. Process automation and technology delivered $3.19 billion, up 4.4%, just under 17% of revenue, steady, and exactly in line with aerospace. Industrial automation shrank, $2.92 billion, down 7.9% at 15.5% of the total. That's a $249 million decline year over year. 3 of the 4 segments grew, covering 84.5% of revenue, and 1 contracted. But strip aerospace out and what remains is one strong grower, one steady mid-single-digit business, and one that is shrinking. A narrower base than the group headline suggests. Now the margin bridge, because direction reverses halfway down the statement. Gross margin fell to 38.1% from 39.1%, A full point of erosion, because cost of revenue rose 4.9% to 11.67 billion, while revenue rose only 3.4. That's input cost or mix running ahead of pricing. But operating margin improved to 23.5% from 22.8. The mechanism is overheads. Selling, general, and administrative expense was held flat at 2,654 million against 2,672 million, even while research and development was funded up 141 million to just over 1 billion. Cost discipline, not pricing, carried the operating line. This is the weakest part of the filing. Operating cash flow for the 6 months was $626 million, down 67% from 1.92 billion. Against 6.5 billion of net income, that's a conversion rate of roughly 10%. Depreciation and amortization was flat at 669 million. So this isn't an accounting charge effect. Capital expenditure rose to 538 million from 416, leaving free cash flow of 88 million against 1.5 billion a year earlier. Meanwhile, dividends took 1.58 billion and buybacks 1 billion, with financing outflows widening to 3.25 billion from 421 million to 1 million. Over 2.5 billion of distributions was funded from the balance sheet, not from this period's cash generation. Total assets rose 5% since the start of the fiscal year to $77.3 billion. Total liabilities fell 1.6% to $58.8 billion. And equity jumped 33.3% to $18.5 billion, driven by retained earnings climbing about $5 billion to just under $56 billion. That reads like balance sheet repair. Debt to equity stands at 3.17 times, return on equity at 35.1% versus 18.1%. But watch the denominator. The equity build is the one-off, and long-term debt went the other way, up to 31.5 billion from 28.7 at year-end, an increase of 2.8 billion. This is a leverage ratio improving because equity grew, not because debt was repaid. This is where the cash flow statement shows up on the balance sheet. Cash and equivalents fell 29.9% since the fiscal year started, to $8.75 billion. The path across the 3 reported dates, 10.35 billion in the middle of last year, 12.49 billion at fiscal year end, 8.75 billion now, a $3.7 billion drawdown in 6 months. Short-term investments were unchanged at 445 million. Working capital absorbed cash too. Receivables rose 716 million to 8.34 billion. Inventory rose 239 million to 6.4 billion, against revenue up only 3.4%. Current assets of 28.1 billion against current liabilities of 23.2 billion leave a current ratio of 1.21. Adequate but thin. Insider activity gives no signal either way. There were 0 open market purchases and 0 open market sales in the window. All 10 reported transactions fall on a single date, the 16th of July, and everyone is compensation mechanics. Code M option exercises and Code F shares withheld for tax. The chief executive exercised 3,090 shares, with 1,343 withheld. The chief financial officer, 2,575 with 1,124 withheld. The general counsel and the head of process automation, the same pattern. Participation is broad across senior management, but entirely plan-driven. Nobody put fresh money in, nobody sold out. That carries far less information than a genuine open market purchase. 4 things to watch in the next filing. First, cash conversion. Does operating cash flow normalize from 626 million? And does the receivables and inventory build unwind? 88 million of free cash flow is the anomaly that has to resolve. Second, the post-spin base. From July, Aerospace's $8.85 billion of revenue is gone. So revenue, margin, and cash flow reset onto a smaller perimeter, and prior year comparatives won't be like for like. Third, industrial automation. Does that 7.9% decline stabilize, or widen. And fourth, gross margin. The 1.0 percentage point of erosion came from cost of revenue outgrowing sales, and recovering it is a pricing and mix question, not a cost control one. One line to take away. Honeywell's operating engine grew modestly and genuinely. Revenue up 3.4%, operating income up 6.6, operating margin up 0.7 of a point, achieved by holding overheads flat while funding research and development. But the headline doubling of profit and the apparent repair of the balance sheet both trace back to the aerospace separation rather than to trading. And the number that matters most is the cash. $6.5 billion of reported profit converted into $88 million of free cash flow, while dividends and buybacks of over $2.5 billion were funded from cash on hand. Until that gap closes on a post-spin base, the operating line is the signal and the bottom line is noise. Everything here is from the filings. Educational only, not investment advice.